Bitcoin prices had a short rise at the beginning of the week, going from $58,221 at the end of last week to $64,500 on Monday. But the top coin had a hard time breaking through the $65,500 area of resistance. Prices fell below $63,000 on Tuesday before bulls tried again, but failed to break through the $65,000 support. Bitcoin is trading below $63,000 right now, and the $63,350 mark is a strong immediate resistance. Above $65,000, especially around the $65,500 mark, there is more important support that bulls need to get past. If prices clearly move above this barrier, they could go up above $66,000 and get close to $68,000 per coin. Even though the cryptocurrency market is in a bull market, there has been a lot of instability lately. Analysts and leaders in the industry keep telling buyers that volatility is a normal part of the cryptocurrency market, though. Yusko, a famous hedge fund manager, tells Bitcoin buyers to not be afraid of volatility because it is a natural part of the market. He says that price drops and drawdowns are important for the big rallies that investors like, even though they are hard. In a recent interview with Jim Friend, host of the podcast Advancing Our Church, Yusko talked about how positive he is about the cryptocurrency industry for 2024 and beyond. He said that Bitcoin is a better investment than stocks, bonds, and cash. No experience with this technology, this new idea was bad. So what went wrong? I've been around for a very long time. Lucky. And I've seen all the attempts to broaden the business. I'm this old just like when I first started in this game. It was seen as bad for trustees to own stocks, right? Remember the cover story from 1979? It was called Death of Equities. And it said that no one with any sense should ever own stocks again because the market had been dead money for 10 years. People were tired from 1968 to 1979 and said things like just own bonds or RISA, then said no, you should really own stocks. You should also own international stocks. You should also own hedge funds and private equity. All of this was brought to Markowitz, who I was lucky enough to study under in Chicago. The Nobel Prize was given to Dr. Markowitz for saying that cash is the safest thing you can own, even though it is the riskiest thing you could ever own. No, you won't lose anything, so it's the best. You're getting less rich, though, because the Fed takes a little of your money away every day through inflation. If you start with cash and then add bonds, those bonds have risk because they can go bad, so the portfolio is less dangerous. The risk goes down as you add stocks. Because they are not linked to each other, adding foreign stocks lowers risk. But there's a catch. For Markowitz diversity to work, all of these assets that don't have a direct link to each other are called uncorrelated. There is a 30% link between stocks and bonds. 60% of international stocks were linked. 80% of small cap stocks were linked. Value and growth were linked 86% of the time. 70% of hedge funds are linked. That's right, they do go down. I would lower the risk if I had real estate, hedge funds, or private equity, for example, and schools like Yale, Princeton, Stanford, and Harvard know how to do this. The same goes for Notre Dame. But here's the thing. Bitcoin has not only done the best over the last 15 years, but it also has the lowest correlation with other assets. There is no link between it and ties at all. What does that mean? That just means you don't know what Bitcoin will do if bonds go up. Bitcoin might do something different if bonds fall. There is no link between them at all. Doesn't mean that they are badly linked. One does not zigzag when the other does. What this means is that there is no information in what bonds and Bitcoin will do. Also, Bitcoin is 0.5 times more likely to go up or down than stocks. The Sharpe ratio goes up more than anything else when you add it to a portfolio. It shows the return per unit of risk and volatility. In other words, if you had put 1% of your money into Bitcoin 10 years ago, your portfolio would have grown to 11 instead of 9, with not as much risk. So what if I had taken 2%? After that, you would have added 3% more. Maybe I should put 5%. You would have made almost 10% more money by compounding. This isn't a promise, though. In no way does that mean this will happen again. But what it really means is that this asset is not linked to any other asset because stocks, bonds, etc. all depend on the same thing. It depends on things like inflation, interest rates, GDP growth, and population growth. All right, Bitcoin doesn't need any of that. There is a digital gap that Bitcoin is all about. Ask anyone over 35, who's your broker? I say this all the time. No, UBS and Merrill are the reason. How much gold do you have? I'm not sure. 3.5%. Just how much Bitcoin? Oh my goodness. None. Don't you get it? It's a scam. Didn't you hear about Peter Schiff? How often do you use DeFi? What does DeFi mean? What do you want to say? Yes, anyone younger than 35 will tell you that DeFi stands for decentralized finance. Okay, ask anyone younger than 35, who is your broker? What is an agent? That is, I have a Robinhood account. Okay, how much gold do you have? Do you really mean that? Boomer is great. None. Didn't you hear about Peter Schiff? What amount of Bitcoin do you have? I don't want to talk about it. Why not? Because it takes up a big chunk of my net worth. I feel bad about it. How often do you use DeFi? Every day. There is a real digital gap after all. Change is good for you. I have a shirt that says embrace volatility because, once more, this is related to Markowitz's idea. He won the Nobel Prize again. I'm not making this up. You want a group of assets with the biggest volatility that are not linked to each other. Like if you want to reduce your risk, put all of your money in cash. This is the stupidest thing you could ever do because inflation will take all of your money away when you wake up. You can buy bonds that are a little more risky, and stocks that are a little more risky might help you keep up with inflation. But this is a false idea about instability. There is no risk in volatility. Volatility is just different opinions about how a business will do in the future. I'll show you what I mean. The price of Amazon.com and Bitcoin changes a lot. 880. This is really cool. Amazon has been a public company for 27 years. There has been a double-digit drop every year for the past 27 years, and this year is no different. Okay, about 31% on average. In theory, this means that you lose 30 years worth of money every year. But when was the best time to sell? You lost more than 90% twice, in fact. But when was the best time to sell? No, never. Who bought Amazon.com at the IPO and still has it today? There are only 5 of them. Jeff, his mom, dad, ex-wife, and Bill Miller. It costs 7 cents for Bill Miller. Okay, not really, it's less than that. Since you just split 10 for 1, it's worth 0.7 cents. That's 177 cents, and it's worth $177. He was the only one who understood that instability didn't matter. What matters is how much value the network builds up over time. The same is true for Bitcoin. Bitcoin is the product that has done the best over 1, 2, 3 years, not 3, 1, 2, 4, 5, 10, or 15 years. The number for 3 years isn't very good because it's been all over the place. But over a long enough period of time, that instability goes away on its own. There is no time in the next 4 years when Bitcoin will lose value, not in 15 years. And that volatility is a good thing because it has nothing to do with the other things in your business. The price dropped from about 10,000 to 8,000 while I was on CNBC in 2018. Okay, it went down a lot, like in the 6 minutes, when I wasn't even on the show for that long. Amy Lee looks at me at the end and asks, so what should we do? We're going to buy it. It's like, yeah, buy it today, buy it tomorrow, buy it next week, she says. Well, you'd always say that about 5. Get it. Do not buy everything at once. Get some today. What Bitcoin is, it's the best way to save money. It's money that lowers prices instead of raising them. That is, the government slowly takes back every dollar I earn doing my job, which is turning energy into value, over 30 years at a rate of 2%. Over 30 years, they take away half of my ability to buy things. That's crazy. Okay, it seems like every dollar I've saved in Bitcoin over the past 15 years has grown in value, but it hasn't. This is what makes it so smart. 1 Bitcoin is 1 Bitcoin, but we don't price Bitcoin in Bitcoin. We use dollars to buy Bitcoin. Okay, the dollar isn't as good as it used to be.